right, we are going to go through one of my favorite topics here regarding cash value life insurance, the flexibility. You know, a cash value life insurance policy, specifically whole life, has the following features that attract so many people. We've got a safe, liquid, tax-free area to position money that is always compounding for me. That has to do with the unique loan feature where my money's constantly at work. But when we hear the word life insurance, when we hear that term, whether it's whole life, term, universal life, whatever it might be, the average person is often going to think bill, fixed expense, unattractive. I have to continue to make premium payments my whole life. I'm not attracted to that. How do I take these core benefits, safe, liquid, tax-free, I can access the money like a personal line of credit and turn it into a flexible savings asset? If I could blend flexibility into this asset, it would make it perfect in a lot of ways. So we can do that. The question that we'll always ask when we are setting up a policy is how much do you want the ability, not commitment, but ability to add into a policy on any given year? If my high-end number is $10,000, then we want to design the policy where I can commit to a minimal amount, call it $1,000, and have the ability to go up to $10,000 per year. Same thing with $100,000 per year, same thing with $1 million per year. The thing is, again, ability, how much do I want the ability to pay in, but I don't want a bill for that. I remember speaking with a really nice couple once. I was after an event that liked the idea of what you could accomplish with cash value life insurance. They wanted the ability to pay in up to $300,000 per year. But the wife specifically said, hey, we want to be able to put in $300,000 per year because our business is doing well, we've cleared all of our debt, but we don't want to get a bill for that amount. How do we design the policy where it is very flexible and I don't get a $300,000 bill? And the exact same thing would apply to an individual looking to put in up to $10,000 or $30,000. We can do it with any dollar amount if the policy is set up properly. The question really is, what is the minimum commitment? How do I commit to a minimal amount so it does not feel like a burden or a high insurance expense, a heavy bill, and I can use it more like a flexible savings asset? This really has to do with the initial funding of a policy. So it 100% has to do with the policy design, and the limits to be aware of are as follows. We have the insurance company limitations, and all insurance companies have slightly different rules here, or limits I should say. And then we have the IRS limits, which have to do with the MEC limit. So we often talk about the premium and the PUA rider. The premium we'll often refer to as what? The initial insurance expense. In respect to your cash value, if I am paying $1,000 per year towards the premium, what you will find is it will purchase you a death benefit first and foremost, but I will have zero in cash value or very little for the first year and sometimes the first and second year. The company's overcharging me for the death benefit up front. Now, once I hit policy year 3 and I continue to make those premium payments, that $1,000 premium or whatever the premium dollar amount is will come back to cash value and begin to capitalize for me. So I will see money show up, we'll start to earn dividends and interest, and gets better and better. However, the initial years, nothing shows up in cash value. Versus the PUA component, if I were to pay the same amount of money here, PUA stands for paid up additions. We'll refer to it often as a cash dump in. You'll see why in a second. So if I were to pay the same $1,000 in, I will see just about $1,000 show up in cash value. That's money I can access. That's money that begins to yield the guaranteed rate. Often a floor of 4% we'll see. And any dividends if the company is paying dividends as well, which most do. So if cash value is our goal, optimizing this area is critical. And a question we frequently receive is, hey Steve, thanks for going through that. I don't really care about the death benefit. Here's the amount of money I want to pay in per year. Let's say it's $10,000 per year. How do I put nothing here into the premium, because again, I don't care about the death benefit, and everything towards this PUA rider to accelerate my cash value growth? How do I do that? Well, we cannot go quite that aggressive, and the reason why has to do with our limits, insurance company limits and MEC limits. So all insurance companies have different limitations. You'll find a lot of the top companies like a Mass Mutual, like a Guardian, like a New York Life, Northwestern Mutual was more flexible before the mortality table update that happened early 2020, but still one of the top companies. You'll find a lot of times we can drive that minimum premium down to 10%. So 10% of what? 10% of how much I want the ability to add into a policy on any given year. So for example, this is where we come up with that term 1090 split. If I want the ability to pay up to $10,000 per year, I may set my premium at $1,000 per year and then have the ability, not commitment, but ability to go up to $10,000. Same thing for the individual wanting to go up to $100,000 per year. We may set the base premium at $10,000 and have the ability to go up to $100,000. Same thing for $1 million. Ratios are the same. $100,000 minimum commitment, ability to go up to, $1 million per year. Now that 10% minimum premium rule is not consistent across the board. Different companies have different limitations. Some will allow you to go lower. Some only allow you to go as low as 25% perhaps. So that's where understanding different companies, the rules and regulations are important. Then the other limit is the IRS limitation, which has a direct relationship to an individual's age and total death benefit on a life insurance policy. And the fun part about this one is we can set that MEC limit wherever we want. The age and death benefit are, call it the measuring stick that the IRS uses to determine if a life insurance policy will still be viewed as life insurance or as a taxable investment in their eyes. However, we can set that limit wherever we want within some respect as far as death benefit limitations are concerned, but we've got some additional video content on that. My point being is if someone says, hey, I want the ability to pay in $100,000 per year, but I don't want to get a bill for that. I want to commit to the minimum. What we would do is set the minimum premium as low as the insurance company would allow. Say it's $10,000, for example. Then I could pay just that and then add more funds into the policy at my discretion, one time per year. Underwriting may or may not be required. That 100% again depends on the insurance company, which we can provide information and flexibility details on any insurance company you'd like. Let's look at a quick example here because visuals are always helpful, especially when I want to use a policy as a flexible savings asset and see the impact of what it looks like. Like my question would be this. If I want the ability to pay in $10,000, in fact, let's use a different number here. Let's assume we want the ability to pay in $30,000 on any given year. What does it look like if I pay in $30,000 and max fund it? But what does it look like if I plan to pay in $30,000, but life happens or I do other things with my money, I don't float through the policy, and I only pay in $15,000? Or I only pay in a minimal amount. It's good to see that stuff up front, and you want to see this with your specific policy or policy samples that you're looking at, whether you're working with us or anyone. So here's an example. This is the same policy with the same insurance company here. If you'd ever like to see detailed information, the insurance ledgers, to see exactly where we pull this data from, the actual insurance companies, that is available in our membership program. And if you're an agent, our agent training program provides all of the nuts and bolts and exactly how to design these policies as well, and a whole lot more. But for this 30-year-old male, $3,000 minimum. So specifically what this means, this is his base premium. Remember those two areas where your money can go? Premium or the PUA component. Here we have a $3,000 minimum premium and $30,000 maximum. What that means is this insurance company will allow a policyholder to 10x their minimum premium. So the insurance company limitation takes that $3,000 and we can 10x it each year, so a maximum of 30. The IRS limit, the MEC limit on this policy, is also set at $30,000. It's overinflated a little bit. It's a little bit over that. And the main reason why is this is a case where we wanted to see funding for a long period of time, 30 years plus. 30 years. If one wants to pay into a policy for a long period of time, in respect to that MEC limit, the IRS limit, we will overinflate that a little bit. So let's take a look here. On the left, we have $6,000 per year going into the policy for 30 years. Base premium, $3,000. PUA and term rider. So we attached a term rider for MEC purposes, but $3,000 allocated towards those two areas. And in blue, you see the total payment of $6,000. There's your cash value. Year one, just about half of it, $2,900 shows up in cash value. What's highlighted in yellow between years 11 and 12 is the break-even point. So this is close to a traditional policy. We have a $3,000 base premium, a term rider attached as well, some money going towards PUAs. In fact, if you want to run a 50-50 split with a traditional life insurance product, 50-50 split means 50% of your total payment going towards base premium, 50% towards PUAs. You'll see something very close to this. He's just about positive or broken even year 11. Year 12, he has more money in cash value than what he had paid in. Then we look at the same policy, but with $15,000 per year going in. So same base premium of $3,000, only now we've got $12K directed towards the base premium, and a couple $100 is going towards the term insurance rider here as well. The term rider pushes our death benefit higher, which has a relationship on the MEC limit. That's the primary reason why we did that. Break-even point, now between years 6 and 7. So by adding more money into the product, we see accelerated cash value growth, accelerated break-even point, and accelerated break-even point, and stronger long-term cash value as well. And then on the far right, you see a max-funded policy. And this is a traditional, old-school whole life insurance product geared for a long-term performance, and we are juicing it from the get-go. Maximum cash value. You can tell I'm a nerd about this stuff, right? So there we go. $150,000 in, $150,000 in cash value. Healthy, 30-year-old male. Now, what we do not have demonstrated on this Excel chart, which is very possible, is varying payments. These show level schedules, 6K, 15K, 30K. In reality, and people always want this with the flexibility, is I might want the ability to pay in 30 per year, but year one, I pay in 10K. Year two, I pay in 25. Year three, I pay in 13, then 27, bounce it up and down. You can do that kind of stuff. The policy design is critical. Everything's got to be set up properly so I don't have to jump through loopholes and go through medical underwriting, so I don't trigger a modified endowment contract, make sure that the company allows it with the right type of flexibility and such, which again, we can provide data on that if you're interested in this. My point being though, is it can be designed to be very flexible if everything is set up properly. So again, the fun part to this is I can take a life insurance policy where so often we think in respect to the funding, expensive. Bill, I have to keep paying into it for my whole life. I have to keep paying 30 years for a long period of time. You can design a policy where we pay into it for 2 or 3 years. Maybe it's 5 years, and then stop, nothing thereafter. Very flexible in that respect. So, as always, I hope this helps. Reach out if you have any questions at all or would like to see some custom samples. We'd love to work with you, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.